During high interest rate cycles, there's a mistake traders repeat over and over again, and it costs millions in the market. The problem is that most people believe they understand high interest rate cycles, but the reality is they're looking at the wrong indicator. If you've traded during high interest rate cycles, you probably noticed something pretty interesting. Even when the central bank signals that rates are going to remain elevated, the market often keeps moving that much higher. This creates huge confusion for traders. Some believe high interest rates always push markets down, but others simply ignore the macro impact, and many end up making decisions based on superficial narratives. There is a much deeper mistake traders often make during high interest rate cycles. Today, we're going to explore what that mistake is, why it happens, real examples from previous cycles, and how institutional traders actually analyze high interest rate cycles. The biggest mistake traders make in high interest rate cycles is pretty simple. They focus on the level of interest rates when they should be focusing on the direction of global liquidity. The difference may seem pretty subtle, but in markets, it changes everything. For example, many traders think like this: interest rates are high, the market should fall. But history shows that's not necessarily true. One of the best examples happened in the 1990s. Between 1994 and 2000, the Federal Reserve raised the interest rates multiple times. And even so, the S&P 500 more than doubled, and the NASDAQ surged during the technology boom. In other words, markets rose during a period of relatively high interest rates. Why? Because what really matters isn't just the interest rate itself. What matters is liquidity, economic growth, and future expectations for monetary policy. You see, during high interest rate cycles, three forces tend to dominate the markets. Number one, monetary pivot expectations. Markets are forward-looking. They don't price the present, they price the future of monetary policy. And that's why markets often start rising months before interest rate cuts actually happen. All right, number two, institutional flows. Another critical factor is institutional flows. Global macro funds, hedge funds, pension funds analyze credit spreads, system liquidity, and earnings growth. If these factors remain healthy, institutional traders continue allocating capital even during high interest rate cycles. Number three, real yield and relative valuation. One detail many traders ignore: the market doesn't react only to nominal rate, it reacts to real yield. In other words, interest rates minus inflation. If inflation falls faster than interest rates, financial conditions can actually improve. Professional traders analyze high interest rate cycles very differently. They monitor three main indicators. Indexes like the Goldman Sachs Financial Conditions Index show whether the financial system is tightening or easing, and many times conditions improve even with elevated interest rates. The credit market often anticipates crises. So if credit spreads begin rising quickly, it signals financial stress. If they remain stable, the market can stay relatively strong. Perhaps the most important indicator of all, global liquidity includes credit expansion, central bank balance sheets, and international capital flows. As long as liquidity continues entering the system, risk assets tend to remain resilient, even during high interest rate cycles. The key lesson is simple: high interest rates don't automatically bring markets down. What truly moves markets is the interaction between liquidity, monetary policy expectations, and economic growth. Traders who focus only on the level of interest rates will often make simplistic decisions during high interest rate cycles. More experienced traders watch something far more important: when liquidity starts to change direction. And when that happens, markets tend to react pretty quickly. If you want to understand the market at this level, connecting macroeconomics, global liquidity, and institutional behavior, subscribe to the Zero Markets channel. Because here, we analyze the market the way professionals do, not just by looking at the charts, but by understanding the macro forces that truly move the markets.